You know what's confusing? You decide to buy term insurance, something very simple, straightforward, and then suddenly there's a whole menu in front of you. Level term plan, return of premium, joint life, housewife cover, increasing, decreasing, NRI group, gig economy special. It's like term insurance walked into a costume party. And now you're thinking, wait, which one do I actually need? So in this episode of Term 101, we're going to simplify this entire circus. We'll break down every major type of term plan you're likely to see, what each one offers, where they shine, and where they completely fall flat. And by the end of this video, you will know exactly which one to go for. Also, if you're still comparing options or unsure what's best for your profile, book a free call with Ditto. We'll literally sit down with your income, age, dependence, and tell you what makes sense. What doesn't? No spam, no sales, just pure clarity. Let's start with the one that most people buy, and it's called the level term plan. Now, this might sound fancy, but it's not. It's a usual term plan. You pick a cover amount, you pick a term, you pay a fixed premium every year. If you pass away during the term, your nominee gets the full sum assured. If you survive the term, nothing is paid. It's simple, it's clean, and this is the one we usually recommend at Ditto because it does what term insurance is meant to do, which is protect you. Now, let's talk about the one that sounds tempting but often isn't worth it. And it's called the Return of Premium Plan, or ROP. Here, if you survive the policy term, the insurer gives you all your premiums back. Sounds great, right? Except they charge you 70 to 100% more for that feature. And when that money comes back 30 years later, it's often worth far less, and that's thanks to inflation. So you're paying more now to get a refund later, which doesn't even grow. Now, in most cases, it makes more sense to stick with the pure term plan and invest the difference yourself. But hey, if you're someone who just wants some return and won't sleep well otherwise, ROP gives you a psychological comfort. That's valid too. Now, here's where it starts getting tricky because you will see something called an increasing cover term plan. This one starts with a low sum assured, say 50 lakh rupees. And every year, it increases. Now you might ask, by how much? Well, 5%, 10%, until it reaches maybe 1 crore rupees. This sounds good because this tackles inflation, right? Except, what if something happens to you in the third year? Your family just gets 60 lakh rupees, not the full crore you probably needed from day one. Which is why we usually say, just go with the ideal cover up front. Don't wait for it to grow because death isn't going to wait for your sum assured to catch up. Now, the opposite of that is the decreasing cover term plan. Here, the coverage reduces every year, usually to match a loan that's being repaid. Say, you're taking a 20-year home loan. This plan might cover just that duration, decreasing as your loan reduces. But again, here's a catch. Life isn't just about loans. What if your loan is gone, but your kids are still in school or your spouse doesn't have a steady income yet? This plan assumes your liabilities will reduce linearly, which real life almost never does. So unless you're only worried about a specific debt, we usually avoid this. Now, let's talk about the joint life term plan, or also known as the couple policy. It covers both spouses under one plan. Now, this might sound very efficient and in love, but here's the problem. Most of these work on a first death basis. See, if the husband passes away, the full sum assured is paid and the policy ends. If the wife passes away first, the payout might be partial or nothing. Plus, riders like critical illness often don't apply to both lives. So overall, you're better off buying separate plans for each partner because there's more flexibility, more transparency, and more value. Now, speaking of spouses, what about the housewife term plan? We made a whole video on this, but I'll still explain this in brief. These are for homemakers who may not have income, but whose absence would still create a financial strain. Think about it. Childcare, running the household, support systems. Now, these cost money. So if the spouse doesn't have coverage, it's a gap. These plans usually cap the sum assured and come with a limited rider. But still, they can be worth it if you want to independently secure your spouse without relying on joint coverage. But just keep in mind though, Eligibility is usually based on the earning of the partner's income and cover. Next up, we have a special entry, which is the NRI term plans. Yes, NRIs can buy term insurance in India and it's often cheaper than buying it abroad. But there are conditions. Some riders may not be available. You might have to do your medicals in India or pay for them abroad. And premiums need to be paid through an NRE account to get the GST waiver. Also, if you return to India permanently, the policy still works. Just let the insurer know and GST starts applying again. Now, if you are an NRI and want to know exactly how to get this done, I'll give you two options. Either comment below and ask us. We'll make a dedicated video for you folks on how to get a term plan in India if you're an NRI, or you can head to the link in the description and book a free call with our advisors and they'll help you secure a term plan. All right, on to the next one. Here's an underrated category and it's called term plans without income proof. I think 3-4 weeks ago, we made a video on this. I'll again link it in the description for you to watch. But to shorten it, these are for freelancers, gig workers, and small business owners, basically people who don't have salary slips or ITRs. Some insurers assess alternate indicators like your savings, CIBIL score, even mutual fund investments to underwrite the plan. The sum assured is usually capped. Riders may be limited, but it's still better than having no term cover at all. If you fall into this category and don't know what your options are, just book a free call with Ditto. We'll help you figure it out based on your cash flow and profile. And finally, the one that most people rely on without realizing the risk is corporate term plan, just like corporate health plan. These are the free covers your company gives you, usually 3 to 5x your salary. And here's the truth, it might sting a little, but it's almost never enough. You can't customize it, you can't add riders, and worst of all, the moment you leave the job, it vanishes like it never existed. So while it's a good bonus, it's not a replacement for your own term plan. Treat it like a top-up, not your main policy. All right, that was a lot. Let's take a breath. But here's the big takeaway, folks. Of all the term insurance types out there, the plain level term plan is what most people need. No frills, no unnecessary complexity, just clean, reliable protection. Everything else from your ROPs, increasing or decreasing cover, joint plans, they exist for niche cases only. So if you're feeling overwhelmed by all these variations, don't worry. We get it. You're not supposed to master them all. That's why we're here. Book a free call with Ditto. We'll ask the right questions, understand your life stages, and help you choose the right type of term plan for your life. The link is in the description. All right, folks, in the next episode, we'll tackle a question that we get every single day. How much cover do I actually need? 1 crore, 2 crore, 10 crores? We'll answer that in the next episode. I'll see you there. Until then, happy insurance hunting.